Ever wonder how a group of individuals can control the pulse of an entire nation's economy, or even world's economy? That's the Federal Reserve acting as central bank of United States of America. This institution, better known as the Fed, has its fingerprints on the veins of our economic system, subtly and not so subtly influencing the flow and pace of money. The Fed acts like a puppet master of sorts, pulling the strings of supply and demand within our economy. It's a game of balance, an act of precision, and the stakes? They couldn't be higher. Now the question is, how does the Fed do this? Well, one of their primary tools is interest rates. Think of interest rates as a dial on the economy's thermostat. When the Fed lowers interest rates, it's like turning up the heat. Money becomes cheaper to borrow, encouraging spending and investment. This leads to an increase in the supply of money, heating up the economy. On the other hand, when the Fed tightens or raises interest rates, it's akin to cooling things down. Money becomes more expensive to borrow, which discourages spending and investment. The result? A decrease in the supply of money, slowing the economy's pace. But the Fed doesn't just control the volume of currency in the economy. It also has a say in what that currency is worth. By manipulating interest rates, the Fed can influence the value of our money. And this, my friends, has far-reaching impacts on everything from the price of your morning coffee to the cost of your dream home. Yet this is only one facet of the Fed's role. They have a whole bag of tricks designed to steer the economy. And while controlling interest rates is a significant part of their job, it's not the only one. The Fed wields a powerful tool, the ability to manipulate interest rates. But that's not the only trick up their sleeve. They also engage in something called quantitative easing, a complex term that we'll unpack in the next scene, so stick around. The story of the Fed's influence on our economy is just getting started. Ever heard of the term quantitative easing? It may sound like a complex economic term, but it's really just about the Fed pumping currency into the economy. Now let's break this down a bit. Picture the economy as a giant balloon. The Fed, or the Federal Reserve, is like a person holding a helium tank. When they feel the balloon needs to be bigger, they open up the tank and let more helium, or in this case money, into the balloon. This is what we call quantitative easing. But how does the Fed pump this money into the economy? They have a couple of ways to do this. One method is by giving banks free money to buy government bonds. Think of it as the Fed handing a kid a few extra coins to buy more candy. The kid is the bank, the coins are the money, and the candy is the government bonds. Another method the Fed can use is to push up financial asset prices. It's like inflating the price of a rare comic book to make it seem more valuable. The price goes up, more people want it, and voila, more money is circulating in the economy. But here's the kicker. While it sounds like a good idea to have more money in the economy, it's not always a positive thing. Just like how too much air can cause a balloon to pop, too much money can lead to inflation, where the prices of goods and services increase. And who wants to pay more for the same thing, right? So you see, the Fed has a firm grip on our economy. They hold the power to control the flow of money and influence the price of goods and services. They can inflate or deflate the economy like a balloon at their whim. But is that necessarily a good thing? The Fed, like other central banks, claims to smooth out economic cycles, but what if they're actually making them more extreme? The crux of the anti-central bank argument is that these institutions, in their bid to regulate the economy, often end up exacerbating economic cycles. Let's delve into this idea a bit more. The central bank's core function is to control the supply of money in the economy. It does this by adjusting interest rates and employing measures such as quantitative easing, which we've discussed earlier. Now, while these actions can stimulate economic growth in the short term, they can also create long-term problems. Consider this. When the central bank lowers interest rates, it essentially makes borrowing cheaper. This encourages businesses and individuals to take on more debt, which fuels spending and investment. However, this surge in economic activity is often followed by a period of contraction, as debt levels become unsustainable. Thus, the central bank's intervention can lead to boom-bust cycles, where periods of rapid economic growth are followed by sharp downturns. Moreover, central banks' actions can contribute to financial instability. When they flood the economy with cheap money, it can lead to asset bubbles, as investors seek higher returns in riskier assets. When these bubbles burst, they can cause financial crises, as we've seen in the past. Then there's the issue of moral hazard. When central banks step in to bail out struggling banks or stimulate the economy during downturns, it can encourage reckless behavior. After all, why worry about the risks when you know the central bank will come to the rescue? Finally, central banks' actions can lead to the devaluation of the currency. When they pump more money into the economy, it can reduce the value of the currency, leading to inflation. This can erode people's purchasing power and savings, which is particularly harmful to the less affluent sections of society. So we see that the Fed's control over our economy can be a double-edged sword. But what would a world without central banks look like? Imagine a world without central banks. Would our economy be more stable, more fair? It's a loaded question, isn't it? But let's give it a shot. Without central banks, there would be no entity to regulate interest rates, to control the amount of currency flowing in the economy. On the surface, this might seem like a good thing. The free market could determine the value of money, interest rates could rise and fall naturally, without any artificial manipulation. But what about the drawbacks? In times of economic downturn, there would be no one to step in and stimulate the economy through quantitative easing. No one to pump money into the system to keep it from collapsing. The economy could be more susceptible to boom and bust cycles, with periods of rapid growth followed by deep recessions. And what about the role of central banks in maintaining financial stability? They act as a lender of last resort, providing funds to banks in times of crisis to prevent a complete financial meltdown. Without this safety net, the consequences of a bank failure could be much more catastrophic. But then again, some might argue that it's the central banks themselves that contribute to these crises in the first place, by manipulating interest rates and inflating asset prices. It's a provocative thought, isn't it? A world without the Fed, without central banks? What do you think it would look like? We've taken a deep dive into the workings of the Fed and central banks today. We've seen how they can manipulate interest rates and currency, how they can use quantitative easing to pump money into the economy, and how their actions can create economic cycles that are more extreme, not less. Understanding these concepts is crucial in today's economy. Don't forget to subscribe to our channel for more insightful discussions, and leave a comment below. We'd love to hear your thoughts on whether the world would be a better place without central banks.